The markets are back open after some hotter than expected retail sales data. We're going to discuss that, the latest moves from famed investors Michael Burry and Warren Buffett, all of that and more today on Money Never Sleeps. Welcome back, everybody. Happy to have you as always. Before we get going, hit those buttons down below, a like, a subscribe, drop a comment in there, share us out on social, all that good stuff. Nothing Kevin or I say is financial advice. We are not financial advisors. We're a few guys who love following the markets. So please do your own research before making any buys or sells. Kev, we see that the markets overall are down on the day off of some very hot retail sales data. What are you looking at as we kick off another day in the markets?
Oh yeah, it's a terrible day to start for major indices, so I've been keeping an eye on that. Obviously, I was up last night late looking at some of the data out of Japan, some of the news out of China, which is, I think, something that we should be making a bigger deal of, and I think Janet Yellen is just pushing it to the side. So I'm keeping an eye on that. And I'm also looking at crypto. Crypto, again, for some of the news that we've gotten in the past 24 hours, should have moved the price. However, we're still pretty stagnant. It's pretty sideways. Bitcoin moved a little bit earlier, but for the most part, I think we're waiting for a move in that market. But yeah, tons of stuff to get into today. Really excited. Lots of news. Happy Tuesday.
Yeah, it is pretty boring here in the crypto streets. TradFi is where all the fun and excitement is right now. We also saw some inflation data out of Canada. The headline number came in higher than expected. However, the core number was pretty good. So things are looking all right up north of us. With the retail sales data, let's talk about that for a second. Came in at 0.7% month over month versus an expectation of 0.4. They also revised up the previous 2 months. Now, there are a few different ways you can look at it. One of them being, okay, people are spending more, so that must mean the consumer is strong. At the same time, if you look deeper into the numbers, you'll see that a lot of it is just having to spend on day-to-day necessities like we've talked about before. So it doesn't really look like this is an increase in discretionary spending. It's just that it's more expensive for people to get by. And that tells me that we're going to see a higher inflation number sooner than later, which, based on everything that has been pointed to us from previous CPIs and PCEs and looking at and the PPI as well, it wouldn't be surprising if the next inflation print came in higher than expected and higher than it was the previous month.
Oh, absolutely. I honestly have pretty convicted here that we're going to see a really good, and isn't good, I mean, for bears, pretty hot number for, CPI in the next print. I think it's going to be absolutely terrible, especially with how the price of oil has been this month. That started in the beginning of August, really, where it started shooting up, right? We're seeing, shelter still being kind of tricky there. But for the most part, the goods are still going up in price. And I mean, even if it's not discretionary spending, still spending on day-to-day goods, that's going to drive that CPI, PCE, a lot of this data up. So it's not necessarily a good sign. And especially after the reading that we got last month, seeing more spending now isn't ideal.
Yeah, the markets haven't really moved much on their expectation for the next Fed meeting. That will be in a little over a month. Tomorrow we get the minutes for the July FOMC. That should be interesting. And then Friday, the Jackson Hole press conference with Powell. The big expectation there is, what is he going to say about how long they have to keep the rates elevated? They've kind of made it clear that they maybe have one more hike in them. That's the current expectation. That could obviously change if they truly are data dependent. But how long do they expect these? The markets are already pricing in 100 basis points in cuts for next year.
Oh my goodness.
Maybe that's a little too much. Maybe that's just right. Who knows? But that's kind of the expectation there. There isn't a whole lot of data besides that. So tomorrow's FOMC minutes, Friday's talk from Powell and Jackson Hole is what the attention is going to be on. Let's also discuss, we briefly talked about Michael Burry yesterday.
Yeah.
I want to talk about that more today, him and Warren Buffett. So yesterday was the filing deadline for a lot of these major firms to kind of give their, what they've done over the last quarter. Let's start with Scion Asset Management, Michael Burry's firm first. They did a few things. So we talked previously that they had put in huge positions in Alibaba and JD.com, two Chinese-based companies. Well, they closed those positions in Q2. That lasted all of one quarter for them. And that is a really big shift away from China, and one that we're seeing was the smart move with the data that has been coming out. So a good call on their part. They also sold their positions in First Republic and PacWest banks. They had notably bought those near the bottom of the dip when there was max fear. I think they exited those. I don't know what is going through Michael Burry's head at any given time, but based on when the movements took place and what we've seen, I think to them, they saw a good opportunity to buy the fear and taking profits. And there's still probably some expectation that there's more contagion coming with commercial real estate with a lot of these smaller regional banks. The largest holdings they have are SPY and QQQ short positions, which we discussed yesterday. I've read some thoughts that like, hey, maybe it's not that big of a deal because it could be, based on the duration of them, the strike price, blah, blah, blah. I think that was just some of the mainstream trying to make less of a deal of it than it really is.
100%.
And because that makes up, like, I was looking at their portfolio between those two, that makes up like 93% of their investments.
Absolutely.
That's not nothing. They
No.
have, I think, about 233 billion under management. Like, yeah, it's not BlackRock size, but that's still not, that's a sizable position. And for so much of it to be concentrated into those short positions, I think is notable. Their biggest long positions are Expedia, Charter Communications, Cigna, CVS, MGM Resorts falls in there as well. So they do have some exposure to travel and telecoms. So I thought that was interesting to make note of there, as well as health with CVS and Cigna.
Yeah, I think a lot of what we're seeing based off that $1.6 billion position, obviously that's the value of the position. It's not necessarily how much money is currently in it, right? He's using leverage and expecting that the market's going to go down to the point where he's going to make money on this, right? So I think a lot of people are trying to knock him down for that specific reason. And here's the thing: he doesn't have to report the strike price or the expiry date at all. All he has to do is report what what the position is itself. So seeing that, I think a lot of people are trying to knock it down because they're afraid that maybe he is right this time. I think a lot of people also don't like the idea that someone is betting against them. So any opportunity people have, I think they're knocking this guy down. But there's a lot going on. I think we're getting a lot of validation that this guy might be onto something. And again, he got into this position roughly last month at some point, and we're just hearing about it now. So I don't know. I think that we are seeing some smart moves. I definitely agree with a lot of his moves, especially getting out of China and what do you call it, like JD and out of Alibaba.
Alibaba, yeah.
Yeah. So that's absolutely, I think that was a smart move on their part. And, he's putting money where he thinks there's value. And I think that's the important thing with Burry is he's going to find value wherever it is. And we can see that he is finding it both in short positions and long positions, even if there's more value to be found in short positions for the time being.
Yeah. With Alibaba, the timing of that one was, in his favor as well. They announced months ago that they were basically splitting the company into multiple divisions, trying to raise funds throughout those. And if you look at Alibaba and who they service, it's a lot of the Asian market, specifically China, and it's a tough time right there for the middle class over in China, and they could definitely see the impact of that. So I think once again, smart moves by Dr. Burry. Let's talk about Warren.
I will say this about Burry too. He's really smart, shorting the QQQ too. So there's tons of companies obviously in this, right? And the same thing with the SPY. Think about all the companies in the U.S. that use China for manufacturing, right? If they're having a slowdown in manufacturing in their economy, they're just not producing as much. That's going to bleed into the U.S. So by and large, it seems like him exiting those China positions, but at the same time, shorting some of the U.S. ones, expecting contagion to hit here. It's pretty brilliant, right?
Yeah. Let's get into Warren Buffett's Berkshire Hathaway. They were a net seller of equities in Q2 to the tune of about $8 billion. They cut their holdings in Activision by about 70%. They had a big stake there, due in large part with the fact that there's so much uncertainty around Microsoft's acquisition of Activision, with all of the antitrust and anti-competition discussion taking place over in Europe. So there's still not a lot of clarity there. One area that I found really interesting was their biggest additions were in home building firms, D.R. Horton, NVR Inc., and Lennar Corporation. And if you look at it, this makes a lot of sense. We've discussed how tight the housing market is, how difficult, the supply is so low because a lot of people who are locked into 3 and 4% mortgages don't want to move and have to pay a 7% mortgage. And there are still people who are looking to move, whether it's a starter home, whether it's they're trying to upgrade, they still need to move. And to look at the fact like, okay, rates are high. We don't know if they've peaked yet, but even when they do peak, they're going to stay higher for an extended period of time. The mortgage rate is not going to get down into the fives, probably not until 2025. Like maybe that's being optimistic,
Yeah,
right? Like even let's say we do see 100 basis point cut next year. Okay, that'll bring mortgage rates down into the low sixes, maybe high fives. They're going to need to keep cutting into mid 2025 before mortgages are at a reasonable level again for a lot of people. So the demand is going to remain moderate and the supply is going to remain low. So investing in firms that are building homes where there will still be a demand there, I think is a very sharp play.
absolutely. You know what you just kind of reminded me of? So it's 100 basis points they're expecting in cuts, right? Maybe I agree with that. Maybe they break something by that time and they have to bring it down that much, right? It's a very real possibility. But I agree. I think that, for the time being, mortgages are going to remain high, right? I don't think we've seen the end of, the housing crisis and also commercial real estate. Those are two things that we have to keep an eye on. And that's also going to bleed into the banks, which, we've seen that a lot of these banks are going to be losing their credit rating, even some as high as JP Morgan. Fitch seems like they're on an absolute tear right now. It's going to absolutely bleed into pretty much all the banking sector. At some point, something is going to break. I think that, we keep rates this
Maybe
high.
Fitch took it personally when JD Morgan said, or when Jamie Dimon said that Fitch's rating doesn't matter. Maybe that was like a little like, all right, we'll show how much that matters.
He's like, all right, dinner served, bitch. But yeah, it seems like absolutely. I have nothing more to add to that other than, I think that rates do stay higher logically if nothing breaks. But if something does break, I think that it's not out of the question that those 100 basis points that we're already pricing in do get cut out of what current federal funds rates are. So, I definitely
Before we get too excited about that, let's keep in mind that that's still going to be incredibly high rates for mortgages and for credit card balances.
Oh yeah,
So,
100%.
like, as always, please, please, please do not be carrying any sort of interest earning credit card balance right now. Like, if it's one thing, I suppose, if you have one of those introductory credit cards where you don't accrue interest on the balance of it, but if you're earning interest, that should be like priority number one is paying that shit off so then you can begin to accumulate assets. Like that is just you're shooting yourself in the foot if you're carrying a credit card balance that's getting 25% interest right now. Like it's obscene.
Absolutely. I mean, yeah, it all goes back to debt. We say it all the time. It's all about debt. And right now we're seeing people having to pretty much pay using debt because, the price of goods continue to go up. Wages are pretty stagnant. If anything, they're not going up with the price of goods itself. Housing's still really extremely unaffordable. I mean, even shelter, even if it is coming down from month to month or whatever it is, it's still pretty high. Like everything right now is really elevated to the point where, okay, debt seems like the only way people are able logically in their minds to make it from one month to the next. So that's not a place you want to be sitting right now.
And when we add in the fact that Moody's has reported that credit card and auto loan delinquencies have now surpassed pre-COVID levels.
Yep.
That's with rates continuing to be high before student loan payments are due again. It's a recipe for disaster, man. Like people want to try to be bullish right now. I think that time, it was the first half of the year, the first 7 months of the year were great for that, but it's time for a little bit of a reckoning, and it is on the horizon. That is for damn sure. We don't need to drag things out for the sake of dragging it out. Like we can keep it pretty quick. Anything else that is catching your attention? I'm seeing the VIX on the rise back up over 16. We are down, almost a full percentage point across the three major indices. Stocks are taking a little bit of a hit. Let's look at Tesla. I want to look at Tesla because you have been kind of trumpeting this corrective pattern, and it is going in that direction right now. So I don't want to pat you on the back too hard, but let's take a look at this so we can kind of continue to see where we think a good buying point might be for Tesla.
Absolutely. I'm not into taking victory laps, but I definitely will slap myself on my own ass for this one because we are doing a pretty good job of this corrective pattern. It's 3 waves down from the all-time high, right? So we came up here back in October 2021 and we put in a 5 wave move to the downside. And then this entire correction, this past 8 months, we've shot up from, or I mean, yeah, 8 months technically from January all the way to where we currently are. And then obviously we're coming down now, but we have been putting in a 3 wave move. Wave one here, when we went to 213, we came down to about 150, 149, or maybe what was that? 152. 152 was the low for the B wave. And then we shot all the way up to this high up here, above 300. Now we're starting to move down, right? And we're moving down in a way that I look at this and say, okay, this is the start of a 5 wave move to the downside. This might be wave one right here. I'm anticipating that we're going to find some supports probably on the daily around the 200 EMA. If I look at the weekly on that, that's probably going to line up with, the 50 EMA. So I think that we're going to probably finish the wave one somewhere down around here. We might get a little bit of a bounce, but then I anticipate us to continue on. So if that looks like, what did that look like? That'll look like, I'll just do it on the side here. Wave one, right to here, a little bit of a bounce, maybe where there's some resistance, a bigger wave three, which I intend to be more the impulsive wave, then another bounce, and then one more down here. Obviously, I think my end goal is a little bit is very bearish. My end goal, I think that we're going to $64 for Tesla. I think that's been in the cards for a while. I haven't changed my opinion on it. I think there's a lot of things that go into that. So let me just change this color so you guys can see that as well. We'll make that yellow. But yeah, I think that 64 cents or 64 cents. Fuck, I wish $64 is the right play in terms of support. Strong support that we have found here. Obviously, it was a really big resistance back in February of 2020. COVID low came down, and we just shot up absolutely an insane amount. And Tesla's value shot up, and I think that's going into where we are heading. We're at the point where people are going to be in extreme debt. They aren't going to be able to make certain payments. That we're going to see tons of delinquencies. I don't necessarily see a world where the luxury of owning an electric vehicle makes logical sense for a period of time. And I think that's going to hurt the share price. And I think it's going to bleed out longer than people anticipate. Again, people are going to try and buy up these dips. That's why I anticipate corrective patterns, right? The wave four and the wave two, people are going to try and say, okay, that was a nice little pullback, but the bull market's here. Let's continue. I'm sorry. We've seen this in 2008. We've seen this in 2000. When people get bullish towards the bottom, they don't realize that there still is a little bit more room to the downside. And that's more the time capitulation. I think people are calling right now time capitulation. Time capitulation happens after the real capitulation. And we haven't seen the real capitulation just yet. So I'm looking at Tesla. I think $64 is going to be my personal entry level for when I'm going to start acquiring some. Again, that's extreme. But I think that with the patterns we've seen, it's been pretty, 1 for 1, 5 waves down, 3 waves up. I anticipate, the final 5 waves down here. And then I think that we're going to see massive support down here where you'll see a lot of people starting to buy. I saw a really good video last night too about traders, and they talk about, how they always get stopped out because their stop loss is so close to their buy. What institutional players usually do is they put their buy where retail investors put their stop loss. So I think if we get down there, there's going to be a huge institutional buy order, buy wall right there at 64, because we see that's where there's a lot of support and resistance and prior to where we broke through. And I think that's going to offer wonderful opportunities for a lot of people going forward. But that's just on Tesla. I might be just the ultra bear.
I like that thought that institutional puts their buy when other people stop loss. But for me, I would, like, me personally, I'm not going to start buying it. Like, I don't think it'll get to 64 for part of that reason. Like, I think there's a psychological barrier for a lot of retail that won't allow them to let it get that low before they sell. Like, I think a lot of retail, I think there'll probably be a sell wall just sub of 200. And I think there'll be another sell wall right around 100. So, like, to me, if we just look at it like some of the psychological, because how people price things psychologically, like, could it get to 64? Sure. But I'll be buying before that point around that thesis, just due to the fact that, like, I think people are going to, they're going to sell far before it gets to that point. I think they're going to capitulate before 64.
Are we making another bet right here live on the show? $64.
I mean, we can. That's fine. That's fine.
We're just gonna cancel out these bets. I'm gonna win one, you're gonna win one, and it's just gonna be like, oh, I hope you guys had fun. I honestly think it's gonna go to 64. I think a lot of the thing too, it's very similar with Bitcoin too. I think a lot of people think that at 14,000, they're like, oh, you know what? I'm going to buy it up at 14K. But I think a lot of people are also forgetting that the global macroeconomic outlook is going to be a lot more pressing on them than they are anticipating, right? I think more people are anticipating a bull run than they are anticipating another 2008 Great Recession. And that might be the most dangerous thing, because once people realize that, hey, it's harder to borrow money now, no one really wants to do any of that. You're maxed out on your credit cards and you got to pay your bills, and inflation's still a real big problem because we're talking short term. That's usually when the market does crash, within those 6 months. I think that people aren't going to have the funds to really buy at some of the levels that they anticipated. And they're more prone to sell than they are to buy. And again, I don't think people who have any savings right now are going to be having cash on the side to buy some of those dips. So I think that we're going to see more of a panic sell capitulation spiral than we are going to see a lot of people trying to buy some of those lower levels. And again, that's my opinion based off of the Big Short itself. When people were freaking out at the bottom, they were still selling. And, I think that retail, once they realize their buying power is pretty much diminished and there's very little money that they have left, they're going to try and save whatever they have.
Okay. Any other charts you want to look at before we wrap it up today?
Yeah, I also want to talk about two things too. I mean, nothing too crazy, but we'll take a look at the total three, because that's just crypto, right? They finally fixed it. They finally fixed it with.
They fixed it. I saw the jump in Bitcoin dominance, so I was guessing they fixed it.
I'm very happy that they fixed it. Thank you, TradingView, because this was kind of messing up some of the data last night. But we could see that this is what I was trying to tell you yesterday. Below the 200 EMA, we get these weekly closes. That is not good for altcoins in general. That means that we are going to see some type of capitulation event, in my opinion, because we're going to start getting this 50 close to that 200. 50 is going to start moving a lot further down. 200 is going to slowly start moving down. But I think that the 50 is going to catch up to the 200 and they're going to cross. Kind of lines up with, some of the volumes dropping lately from at least from October 2022 to where we currently are. Price has been going up since, June of this year. And we can see that we're pretty overbought on the stochastic RSI, and we're coming out of it and got some room to the downside. What is that capitulation? I have no idea. Again, I think that we're just seeing that this is already happening, and I don't necessarily see the opportunity for a reversal here. I think that we're seeing a lot of money slow down in these markets, and once the money is absolutely out, I think we're going to start seeing that more of the money's to be made on the downside, right? I think people are going to be chased out of their long positions, and I think that's what's going to be on the forecast for us in the next, I'll say, 2 months. I honestly, I feel confident saying the next 2 months we're going to see a pretty significant downside for the alt market. So we'll just keep an eye on that. But once we keep getting rejected off this 200 EMA, or we start closing below it. I mean, we have, and again, we're above the 50 EMA right here on the daily, but we can see how overbought we are on the daily as well. Price really hasn't moved that much. And again, I mean, if I'm going to be an asshole here, pull up the parallel channel. I can see it right here, right? Parallel channel right there. It's probably going to break to the downside once again. If we keep doing this on the way down on the macro, we'll see that bigger picture that this is absolute collapse. And we'll probably be somewhere down below this 300 billion. So keep an eye on that. Bitcoin also, want to look at that real quick, because it's really wild what Bitcoin's doing. We got the spot ETF approval in England or Europe, but next thing you know, price hasn't really done much. It's actually down $100 today, and we're probably not going to get any ETF approval till March 2024. So all those hopes and dreams have been, crushed for the time being. Maybe we'll see one next year after the crash, but for the time being, right now, Bitcoin hasn't been doing much. I've been seeing tons of supply go on chain. So a lot of people are throwing on the Coinbase. I saw $87 million this morning. Yesterday, I saw about $75 million. They're just throwing all this supply in the exchanges, and I think that they're going to try and get out. So maybe we do see a bit of a push to the upside that allows them to get out. Maybe we find that resistance once again at 31, 32K. Keep an eye on that. But for the most part, I don't think crypto is going too far anywhere right now, at least Bitcoin, to a point where we can start being extremely bullish on this market. Now, that's all I have in terms of the charts for crypto, but I do want to show you two things. So Janet Yellen came out last night and she started talking about how she's extremely upbeat on, the U.S. economy, right? And the things that she says that are kind of scaring her, if anything, are the war in Ukraine, obviously a little bit of what's going on in China, and then climate. They think that those are three expensive battles that the U.S. might see some trouble ahead. But she says that the U.S. economy looks pretty strong, and that's what the headline is here from Reuters, right? Yellen upbeat. Get this dicks out of here. Man, I hate ads. Yellen upbeat on U.S. economy, says Bidenomics is driving investment job growth, right? This is August 4th, 2023. Just want to show you this one article from a few years earlier, back in 2007, November. U.S. Treasury's Paulson says economy healthy. Guys, I think it comes with the job that they have to say that these things are looking pretty good, but I think we can both agree that the macroeconomic outlook for not just the United States, but for the global, China looks terrible. Japan looks terrible. We're starting to see Russia. I mean, Russia raised rates today, 12 basis points or something like that. We're not in a place where, debt is where you want to be. The United States is over leveraged in debt. We all know that. This is kind of like history repeating itself in some ways, right? We saw that Japan's GDP was at 6%, grew to 6% year over year. It's not a great thing. It kind of tells me that we might see a potential short squeeze on treasuries, which is also terrible for the U.S., right? Imagine China and Japan start selling off their treasuries and securities and anything in the U.S. Well, that's going to mean that short-term interest rates are probably going to skyrocket, right? It's going to be, they're going to try and get money in any way possible so that people will invest and, throw some debt so they can just pretty much borrow money. And if that happens, it's going to get to a point where it just doesn't make sense, right? I mean, 7% interest rate on, I don't know, like a 4-month treasury. Is that possible? Sure. We haven't seen that in, years, but I mean, I don't even know if we have ever seen that actually, but it'd be kind of scary to see that. And that would probably give me a lot less faith in the U.S. And this kind of lines up with what Fitch has been saying, that the U.S. is not good for its debt, not as good as it once was. So I'd be really terrified of a lot of that. And, some of these numbers that we're getting out of Asia, it's not over. I think that the Bank of Japan has said that they are going to take some drastic moves. Likely that's going to be raising rates. China, again, you and I were talking about this before the show, but they're saying that they're not going to allow anyone to say that there is deflation, and they're not going to say that's what the youth unemployment rate is anymore. And something I saw in China that's really wild is that some parents are even paying their kids to be stay-at-home kids. Like, this is absolutely insane. They're just doing chores pretty much. They're just giving them an allowance. But that's how bad the job market is in China. And they are not hiring people over the age of 35 under the assumption that they're not going to be willing to do overtime work. So it's really tight right now. And you have a lot of older people that are fighting younger people in China for work. This is going to be massive. And I mentioned how U.S. Production is a lot of that, or production for a lot of U.S. goods and companies is done in China. Well, if they can't find work, your Nikes of the world, your Adidas, all these ones that outsource work to China is absolutely going to just go bust.
Kevin, the last time that the 6-month treasury was this high?
I'm going to guess it was during a recessionary period, right?
Back in 2001. When the next time it was close to that high?
1929.
August of 2007.
Damn. 1929. Okay. Maybe I'm a little bit too bearish then there, but yeah, I'm not surprised, man. This is we're probably going to see a bit of a squeeze in T-bills. And
it was funny. What's also funny? That article from 2007 was showing a picture of a shopping mall, and shopping malls are a huge part of the commercial real estate disaster that is shaping up. So it's just kind of funny how everything just eventually comes full circle.
And you're being lied to every corner, telling you that they're in a bull market, that the U.S. economy is looking great. They're putting on you're getting political theater right now, if you know what I'm saying, on every channel, but you're not finding out what's going on in the world outside of your country and how it's going to impact your finances. Focus on the economic. Don't worry about all the theater, the TMZ bullshit that's going on, because this is going to get a lot bad. It's going to get a lot worse than people anticipate. And at the end of the day, you want to protect your wealth, your family, and you want to survive what's going to be likely a very hard time for Americans.
All right, we're going to end it on that sunshine and rainbows of a note right there. Appreciate everybody for watching. Once again, if you have not yet, hit those buttons down below. Give us a like, a subscribe, a comment, share us out on social, all of that good stuff. We'll be back tomorrow discussing the FOMC minutes that will be coming out at 2 Eastern. Looking forward to diving into some of the Fed speak, some of the data points there. Have an awesome rest of your day, everybody. Stay safe out there. We'll see you next time.
Take care, everyone.